Welcome to today's session. We're going to be presenting the BBVA European Bank's income note. My name is Jill. We have the Cashbox All-Stars with us tonight, including Graham. Andrew and Chad are going to take us through the details. Devon's manning the chat, and Logan is making sure the tech does what it's supposed to do. So please feel free to post any of your questions in the chat as we go along. And for those who are new to structured notes and would like to set up a one-to-one chat, just pop a message in the chat together with your email address and Devon will be in touch with you. So with that, first, always there's some housekeeping that has to happen. A reminder that we do not provide advice. This session is for education and product information only. We always encourage you to do your own research and due diligence before making any decision. Our full disclaimer is available on the website for you to go and have a look at. So with that, I'm going to hand over to Andrew.
Right, thanks, Jill. Thanks very much, everybody. As usual, we've got a lovely bridging the gap between institutional returns and the retail investor. It's got a European theme, so it's an income note. It's been structured by BBVA as the issuing bank. We've used them before. Many of you have been in notes with them. It's got an interesting theme in terms of where I think we are in terms of the world economic cycle and what's happening around us on a day-to-day basis. It's got a fairly, if I can call it, and I'd like to tip my hat to Graham, who's done a heck of a lot of work with the structuring banks to get us over the double-digit coupon line, and we can invite him to have his thoughts later. But it's becoming harder and harder with these higher global interest rates to structure a return where the banks are prepared to give us a premium to what they're just attracting money hand over fist at the moment. But it's a very useful note in terms of the theme that we've been following for some time. We've followed banks very successfully for a long period of time. Banks are normally defensive, and we'll get into that. So it's got a double coupon. We just crept over the line, 10.10. It's a semi-annual coupon, so every 6 months. It has an observation to either pay out and also after a certain period of time to actually early mature. That's the reducing order call. The closing date is the 29th of August. Again, it's a little bit like the 100-meter sprint in Paris. You're out the blocks and you've got to go like crazy to get in. We've got inventory. Graham's kindly. We're up to around about $1 million that we've got available. Someone's already spoken for beforehand. So that's the beautiful picture. That's the note. It's available. It's live. The fact sheet is there. There's a rationale there, which I really would encourage you to read, because I'm going to go quite quickly through quite a lot of slides tonight. But the rationale takes you into a journey, I think, of positioning and framing the context of where we are currently, to a little degree where we've come from, but more importantly is where we're going. I think that's what people are going for. So let's have a look what we woke up to Monday morning. And so if you're driving this, we woke up to consternation overnight. As the world moves in this circle, time zones, we woke up to the fact that there seemed to be absolute chaos emanating out of the Asian markets, specifically, primarily Japan, the Japanese market, the main Japanese markets. And really that framed and contextualized the noise. I call it the noise that we have to face on a daily basis, whether it be through social media, whether it be through anecdotal talking to people, whether it's podcasts, webcasts, Zooms, webinars, printed media. There's so much going on in terms of what we are having to face with expanding Middle East wars and East European wars, conflicts, nuclear submarines being dispatched all over the place, aircraft carrier fighter groups, interest rates being stuck, bad news reports coming out of for example, the US, and then the Bank of Japan puts up interest rates for the first time in about a zillion years. So they went to the heady heights of 0.25 after years and years of negative interest rates. And I suppose that poor fellow, he's a trader probably on the New York Stock Exchange by the looks of it. He was like flummoxed, like, where do we go? And you can read the sort of back screens like stocks plunge, X, Y, and Z. We've got some screens to show you that. So much so that it caught so many people unawares, and it was a bit of an imperfect storm. By Thursday, I think a lot of calm had disappeared. I mean, I beg your pardon. A lot of calm had appeared, and some of the fear and anxiety had disappeared. But we unpacked it in a webinar on Thursday. There is a link that you can have a look at if you didn't attend. We had a very good attendance. Just to simply in a 30-minute quick uncovering sort of expose, what are the primary drivers and reasons. We'll run through them again just quickly for clarity for those who may not have seen it. And then we'll move on to why we have moved into a more defensive, risk-off kind of environment. And this is this noise in the storm. We've faced, as I said, on a daily basis, lots of noise, lots of conflicting questions, opinions, armchair experts, you name it. And the storm was what basically eventuated with this guy scratching his head on the New York Stock Exchange or the NASDAQ, wherever he was, saying, what WTF, what has happened here? Because markets just plunged and there was absolute chaos. And I think what's happened is that as we go into the latter part of 2024, 2024 hasn't been a bad year. It's certainly not 2022 and it's not 2023, which was a good year, but we're starting to see signs of almost like, certainly in the States, some very strong rallying points. But there's an expectation, and this is one of the biggest problems I think that the market, as they call it that, creates. There are realities in terms of what a company can create and what a company can deliver in terms of earnings, in terms of profits, etc. But the so-called market expects them to reach a certain benchmark or a point. And often those expectations are way beyond what the company is actually valued at or should be valued at. And we've seen extreme stretched valuations of companies, running into multiples into the hundreds, which is a little unnerving if one comes from a background of technical, quantitative, and qualitative analysis, which says, well, at these stretched price earnings ratios, these companies are actually perhaps not worth what their valuations are saying they're worth. And a lot of that is momentum investing. A lot of it is thematic because it's either an AI theme, and we followed that. I've got no excuses for that. And there's a reason for it. But in terms of where an investor's money rules or conscience or discipline should come from, one needs to look at what the next 6 months are going to bring and into the next year, because whatever we are putting into place now needs to play in terms of a theme or in terms of a reference strategy, in terms of our structured notes, needs to play out, not just for the next 3 to 6 to 12 months. It needs to play out into a longer period. So it's something that one needs to understand, that structured notes, while they have early maturity opportunities to exit, the bank to say, right, we're closing it down, we're returning all your capital and you've enjoyed all the coupons. And one needs to say, well, will this rationale, will this thinking still be a good thinking, a coherent argument to be in a particular sector? Now, Jill, if you can maybe move along, let's just have a quick look at that storm, because it was pretty violent. So Logan, our IT guru, has put this together. And what we did is we showed, this is a sort of a longer term picture. It goes back, I think this is a year on year. We've got the S&P, we've got the UK market, we've got the Nikkei, which was really the bellwether sort of canary in the mine when things started going wrong on Monday. And we've also included a Eurobanks index, because that is really where we are going with this next note. Okay, that's the underlying reference theme in terms of going more defensive. So you can see, obviously, since the beginning, if you go to the left-hand side of the screen, things were, and as one moves on a trajectory across the right, in as much as nothing moves in a straight line, things were on the up and up. And certainly, if one looks at, the green line, which is the banking line, it was doing quite well. Yes, it's got its ups and downs, but certainly everybody, both, all those four markers there, saw a precipitous sort of not collapse, but precipitous downward movement on Monday. And you can see the little tail that's sort of kicking up afterwards in terms of, yes, it was overdone. Yes, it was overblown. And subsequently, the cool heads have prevailed. An understanding of what caused that imperfect storm has been sort of disseminated and desynthesized. And now we can say, well, hang on, it was done for the wrong reasons. Fear and panic and anxiety took over from rationality, a little bit like what was, the invisible face of COVID. We didn't know what COVID was, and it was a similar sort of thing. It wasn't as big, it wasn't as dramatic as COVID. But you can see there were some big movements done. Obviously, the biggest movement was the Japanese market, the pink line. It went, at one stage, it went down sort of 12, 13%. Calamitous drop from a market that's been very, very resilient. If you look at that pink line across the time, it's done very well, slow, steady, and it's moved up pretty well. But you can see they've all pretty much starting to recover and moving upwards. I was late onto the call actually because I was following I was listening to a re-recording or a recording of some of the results in the United States tonight. And I don't know if any of you are looking at the S&P or you have it on screen, but it's off and running. It's sort of out the blocks tonight because a lot of data points are coming out, and it looks certainly as though inflation, despite that jobs report, employment report last week, which was very lackluster and lukewarm, every other point is coming out a lot more positive and pointing in the right direction. So the S&P, NASDAQ, Russell 2000, the small cap guys, everything, the Dow, it's all green. There's a sea of green at the moment. So it's very positive. But that's the noise. And tomorrow you might see people profit taking and you see a slight movement down. So at a point in time, around about 5 weeks ago, we as a team got together on a strategic basis. We've always been a risk-off kind of company. And I did say in the thought leadership discussion, which we had last Thursday around this issue, was that we needed to we do treat our community like family, as if we were our own families putting money into this, recommending, friends and family to go in. And we decided that expectations of earnings are going to be difficult. Growth is going to be difficult. In as much as there's an American election with all its histrionics and showmanship and this sticky interest rates, and I'll deal with that just now. We need to be cautious, I think, to a degree. We've got a lot of exposure to tech that's still running and doing quite well, and all sorts of different sectors and all sorts of different themes. But in introducing a new note, in these troubled and uncertain times, there's nothing wrong in adding to a portfolio a solid sector that brings predictability, and it's really a behind the moat type of note. In other words, I talk about behind the moat and outside the moat, but behind the moat is really behind the castle walls. You have a lot more protection. There's a lot more predictability in terms of the sector that you are choosing as your running stable. So I mentioned earlier, we've had a lot of success with the banking sector, 11 notes in all, going back, pretty far back to 2021, 2020. They've all, barring one, they've all run short of their term. It's only the very first one. It was a 1-year term deposit. It ran full term and it expired after 12 months. The rest have all auto-called. In other words, they've all early matured at some point 6, 9, or 12 or 18 months into their 4 or 5 year term. So it's a sector that has a low volatility sort of rating in terms of some people might say it's boring, it's doer. It's not a fizzy 20% one day, 16% the next day, 5% down the next day. It pretty much tracks the scale of economics of a particular country and of a particular zone. And if it's a global company of sort of global influences. But they are, I suppose, akin a little bit to like a super tanker as opposed to, I suppose the analogy would be a speedboat. These are slow, steady performers. And as you mentioned, as I mentioned always, you don't need a speedboat in a structured note. It doesn't have to shoot the lights out. That's all contained in my rationale. So what's in a name? I thought this would be quite interesting because the 4 companies that we have chosen are all tier 1 A-rated companies. The definition of tier 1 is in the rationale. But these are big companies. They run into the billions and billions of euros in terms of their market capitalization, in terms of their size. 3 of them are the leading sized bank, if I can call it that, in their particular countries, and we'll go through those quickly. And the third, a French bank, is number 3. So let's have a look at the first one, and you'll probably be familiar with all these names because this is the Premier League. These are the big boys, if I can call it that, the big bad boys. Santander is the largest investment bank and bank in Spain. It's one of the largest in Europe and certainly in the world. I always thought it's quite interesting. What do the little logos mean? And there's a sort of theme through all the banks as we show them up. So this is a Spanish bank. We've got a Dutch bank. We've got a French bank and a German bank. So they're pretty much the core, certainly Italy as well, but they are pretty much the core of what is the Eurozone, effectively. Santander has got a very interesting, it's quite an iconic. It represents the element of fire, that little logo. I always thought it was a little hat, but it represents the fire, evoking the role that I think fire has played in human evolution and in prosperity. An ally, I think, that has helped us evolve as a species. The next one is a Dutch bank, okay, ING, Internationale Nederlandse Groep. It's got a little lion. That was quite interesting. What does a lion mean? And its orange lion is really going back to its Dutch root. Orange is the color of Holland. And interestingly enough, the lion is the national symbol. South Africa, I thought we had dibs on the lion. We have Springbok, but the lion is pretty much part and parcel of our DNA. But that's their logo of their lion, and I think it represents strength. It represents the national strength of Holland. Its rich history, several Dutch companies features lions in their logo. But again, you're starting to hear strength, stability, size, opportunity, growth, prosperity. So moving on to the next one is Société Générale. The French have normally got this is the third largest bank in France. They've normally got a flair for doing things. I mean, the Paris Olympics certainly showed their opening and closing ceremonies were quite interesting. But this is a block. It's quite difficult to move a block. It's quite solid. It's stable. I think it tries to define this relationship between its clients and the bank itself: solid, dependable, secure. The top is I think that represents the clients, and the black represents the bank itself. So there's there's the symbiosis between clients and banks. These are all nice. This is all bank speak. I mean, banks always say we're their clients, and I think they forget sometimes it's our money, not theirs. And then finally, moving on to the last is Deutsche Bank, typically German, not too much flair, very distinct, also a block with a sort of slash inside it. And they certainly is, again, they call it dynamic growth. If you Google it, it's dynamic growth in a stable environment. So again, stable growth, protection, square, hard to move, hard to ruffle. And I think again, sort of basically stable. So if I drew a line through that, or if I pulled a sort of a thread through this, a golden thread, we are looking for stability in this troubling, noisy time. We're looking for stability, security, and something that is not going to, causing us to wake up at night and say we're down 30% or whatever. And so in a nutshell, these are the four companies. BBVA is a Spanish investment bank, one of the largest. Again, also tier one, not AAA, but A rated. And they are an issuer who have been very, very involved in this space for many years in terms of issuing debt off their balance sheet. They're comfortable to do that, to create these notes, feeling comfortable in terms of their analysis and what they want to actually achieve out of this. I think certainly in terms of, in a nutshell, I think in this time of increasing turbulence, there's an opportunity, given the history, as you saw, with 11 notes having either matured very quickly or during their term. There's certainly a place for banking still to remain in the sector. It's all got to do, in some respect, and this is comprehensively dealt with in the rationale. There's a bit of a seesaw and balancing act at the moment between the central banks and obviously the other banks, the retail and private banks. And it's got to do with interest rates in terms of when is the interest rate cutting. And you'll see, if you have a look, and this is being recorded, you'll have a look at those charts as they were moved up in the last year. They all did very well because they were making lots of money on our debt, paying our credit cards, our mortgages, homes, etc. So banks did very well during this period, and their valuations obviously increased. Towards the end of last year and into this year, we've only had one cut in the ECB, the UK, none in the States. That's probably going to come next month, and in September at the next meeting. But certainly it's been tough for many consumers, people at the lower end of perhaps the financial earnings scale have struggled. People who've got savings, who've got wealth, have been able to have a buffer. And that's the bank's problem, because if these rates stay too high for too long, then what happens is the bank needs to start making provisions off its balance sheet for potentially toxic debt, for foreclosures, for disappointing returns on their investments that they've given out. So banks are quite keen and like to put pressure on the central bank to say, well, now's the time. And certainly we saw it. Christine Lagarde reduced. They've had one cut in the ECB, but she did say, this is not, we're not going on a willy-nilly roller coaster of cuts. We're going to watch the UK and the States quite carefully, because the world is interconnected in terms of trade, in terms of economies. And they need to look very carefully as how they let the handbrake down so it doesn't become a roller coaster, that it becomes a controlled descent. There were a lot of calls last week during all this noise and thunder and everything else that the Fed, the US central bank, needed to jump in the next day and have an emergency rate cut. And once I think people had disseminated and got granular in terms of what were the causes, they realized, no, that's not going to happen and it's not necessary. Okay, and it's certainly not necessary. There were also towards the back end of last week, there was I think I read percentages, there was 70% agreement across Wall Street that there was going to be a 50% basis point cut in September. That's now down to 33%. It now looks more likely that they're going to go the very slow mechanism of going only down by 0.25%. Look, Jerome Powell is a very cautious man. The Federal Reserve is also very cautious. They got it wrong 3 years ago when they said, no, inflation is transitory. That was the word that everybody hung on, transitory. And it's turned out to be very sticky because it's taken 3 years to get this beast under control. But I think because of that, they are really going to take their time. They have to make sure, and they are supposedly apolitical. The rhetoric in the background between Trump and Harris is now that we need to look after our seniors. That was all over the media today about giving tax-free seniors income, taking tax off them. But they need to make sure that they do balance the timing and get the timing of the cuts right and the number of the cuts right. So, yeah, I think there are going to be cuts. So that's going to affect the banks. I mean, that's in America, but certainly in Europe, and these are the banks we're concentrating on. What they were earning in us paying them more for our loans and debt is going to come down a little bit. But by the same token, it will give them opportunity to maybe increase their lending in other areas where it's been unappetizing. So at these high interest rates, people applying for mortgage bonds or mezzanine finance for their buildings or businesses has tapped off. So whilst they've made hay, if I can call it that, with what's called net interest income on cash, they'll sort of balance that off with now saying, well, people are happier to lock in a rate on home loans or mortgage finance or whatever it might be. So the bank, I don't think they want to tip the scales too quickly, because they need the banks also to move in tandem. And it's very important why we've chosen such big banks. Okay. As I mentioned, these, Santander 60 billion euro plus market capitalization, etc. They're at the top end of the scale. SocGen is small, it's probably at about 20-something odd billion euro. So you become a little bit desensitized to the numbers. But these businesses go into the fabric of those economies and those companies, I beg your pardon, the companies they represent and their countries. Very important. A bit like, sort of Barclays would be in the UK, HSBC, Lloyds, etc. In the States, the big four there. These are big, big, powerful movers. The governments have got an interest in these businesses doing well. And if you look at their share price fluctuations as individual companies, it's not all over the place like in an NVIDIA or an AMD or a Tesla or something like that. These are unfortunately the perceived dull, boring banks. Nobody likes your bank because they never want to give you money when you need it, and they always want to take it back when you don't want to give it back to them. So they have a place to play. It's a defensive play. We think it's the right product for the right times. And I certainly believe $1 million is not going to last for too long. So that's my health warning on banks. And I'm going to throw the fun stuff over to Chad. And thank you very much for listening to me.
Cool, Andrew. Always interesting. Thanks, bud. So the gist of this, and well done, Graham and Andrew, in getting this produced. We know it's BBVA. We know they are A-rated. Everything is good there. We know the reinsurance rate in the bank is good. We're comfortable. We have a income coupon, and this income coupon see a spelling mistake or a typo there, sorry, is paying out 5.05 semi-annually every 6 months. As long as the conditions are met, 5.05% would then get transferred into your trading account. The term here is maximum of 6 years. We'll have a look at the graph just now. Those that have done structured notes before know that we're quite excited to see that these products actually mature early. It's probably unlikely it'll get to 6 years, but what is really nice about the bridge analogy, again, if we go through troubled times and we need a longer runway, we'll get that right. And again, I'll explain that through our graph. So while it's a maximum 6 years, it's probably not going to run that long. The autocall trigger, in other words, the early maturity, which speaks to the 6 years, we need to get to a value that gets to the autocall trigger. The autocall trigger is set at 100%, and the first observation at 12 months means that this product will run for a minimum of 12 months. And then semi-annually thereafter, we're going to have a look at the valuations. And the autocall trigger is going to get easier and easier. It's going to reduce by 2.5% every observation. And we'll show you the net result of that just now. We know who the underlying banks are. As always, the underlying banks in this reference basket are only there for reference to have the contract run and for the terms and conditions to pay out. At no time do we ever own those shares. They're only there as a reference. The capital protection, the bank is underwriting our capital. We know it's safe. We are on their balance sheet. The only time that capital is ever at risk, as a very final observation, which would be the end of 6 years if we get that far. And again, I'll take us through how that works. On an availability point of view, as you know, we get a certain subscription from the bank, a certain inventory, and the product will either close out at the 29th of August when the product will go live, and or if we've used up our full allocation. The minimum investment in this case is $10,000. The product is only available in USD. We are getting a lot of call for GBP, so we are looking at that. But in this case, this is a USD-based product. Thanks, Jill. So let's have a look at how an income-based note works. The blue line, if you like, is a fictitious market cycle. And the reason that we're going to use this is just to see where this note's going to go. So when the product starts, we have our trigger levels, our subscription levels, as you know, our strike values, and we're going to measure and check each of these shares. If at month 6, which is observation 1, all the shares are above the income trigger, and in this case, this note, the income trigger is set at 50%. In other words, as long as any one of the underlyings has not dropped by more than 50% in value, and for a bank to lose half of its balance sheet is enormous, we would get a 5.5 payout directly to our accounts. And again, that would be on month 6, month 12, and so on, observations 1, 2, 3, etc. From month 12, the autocall trigger starts off. You'll see the little gray dots where the indicator is, suggesting then at 1 year, even if these 4 underlying banks have stayed level or flat in their valuations, the product will auto-call. Anything above that obviously is an auto-call. Anything below will continue with the program. And so we carry on all the way until, let's say, observation X. Observation X, sometime in the future, as long as all the shares are above the auto-call, we're away. But do you notice the autocall trigger levels are descending? And as you know, we're descending by 2.5% per observation, or 5% per annum. And if it was to run all the way to 6 years, that autocall trigger level has dropped all the way to 75%, meaning the lowest share can drop as much as 25%, and we would have collected all of our income. The very last observation, our capital protection barrier comes into effect. And another wonderful thing with the structured note, shares can drop all the way down to 50%, and we will still get our full capital out. So it's wonderful. It's like investing with insurance. If we go below 50% for any one of the underlying shares, we will get our cash out on a 1-for-1 basis. So if one of the shares drops to 42% of its start value, we would get 42% of our cash out. An unlikely event, but nonetheless, the terms and conditions are built in there to protect us. So a strong likelihood for income and a strong capital protection is exactly what we're wanting in strong stocks with and from a strong bank. Thank you. So let's have a look. The other piece of protection built in is what we call the memory feature. So during the life of the product, if any one share was to drop below the 50% income trigger, we don't mind. Why? Because that coupon is not lost. It's put on hold. And as soon as the shares are back over that 50% level, it would pay out the value at that coupon, the coupon at that observation, plus anything that may have been missed before. Wonderful feature and a wonderful piece of protection built in. Alrighty, so the page that we all love to see, and a defining piece of a structured note is we have a defined observation date and we have a defined payment date. That's the payment date that the bank, BBVA, will pay to our online trading account. So the first observation is going to be on the 28th of February, roughly 1 week later, the 7th of March, should the shares, the underlying reference basket be at or above 50%, the cash will flow from BBVA directly to our trading account, and you'll probably see it in your trading account within 2 business days thereafter. And so I can build a steady stream of income on a defined date, as opposed to perhaps buying shares and not knowing directly and not knowing when it's going to pay out. Now, the income trigger remains the same at 50% for every observation, but do you see on the far right-hand side, we're going to have an auto call trigger, and it's not available at observation 1, being 6 months into the product, but it is available from observation number 2. So as long as the shares are at or above 100%, on the 1st of September, the product will auto call or early mature. Then do you see the auto call triggers descending? It's getting easier and easier and easier and easier at the auto call. It's exactly what we want in order to get our capital back out on the same payment date with our last coupon, look at the market again at that point in time and say, okay, great, we're going to go again and we'll pick the next opportunity. Cashbox launches a product every 4 to 6 weeks on average, depending on market conditions. And at that stage, if your cash was to come out, we'll hold on a week or 2, see what else is new, and you're welcome to go again. Thank you, Jill. You want to take it from here?
Great. Okay, thank you. So just a reminder, when it comes to issuing the structured note, by the time it's hedged, that bank is comfortable with the underlying stocks and that they will be able to make a healthy profit. With the structured note, you're practically in partnership with the bank. Then from the investor's perspective, the investor needs to take a view on the strength of the bank, because that is where the risk lies. Will the bank be around? And that's why we've chosen such a strong bank. We only work with the strongest of banks. And then that the underlying stocks are not likely to drop below the capital protection barrier, because that is the only point where you have risk to your capital. So those are the various things that you need to take consideration of. Then how to invest in the note. As Chad mentioned earlier, you do need a trading or a custodial platform. They hold a contract on your behalf. The trading platform can hold other securities and they provide you the tax reporting. If you don't have a platform, we are able to help you with one and give you some information. What we do is provide you the ISIN number, which is the International Securities Identification Number, and that uniquely identifies the security that you're going into. And that is something that we provide to you. And then from our side again, for the reporting, we let you know when the note is issued. Each observation, we report to you quarterly or half yearly in this case. At maturity, if there's an early maturity, and then we let you know about new opportunities that are coming up. Again, the closing date for this note is 29th of August. And then our ongoing support regards to refresher training, It's a lot of information that happens. You forget about anything or you need a reminder, that's what we're there for. Education as well as support. And with that, I'd like to open for questions, if there are any questions.
Thanks, Jill.
Jill, may I make a comment? I'd like to invite Graham into. Graham is of IDAD, our structuring partner. I'd like him to make a comment on a client of mine who we submitted the deal today. He's actually invested $300,000 into this note.
Wow.
His comments were with falling, as rates go down, as I discussed, it's going to become more and more difficult to get a double-digit return in terms of cash rates or people hunting in the money market or even in the bond market with capital uplift. He says he'd rather lock it in now and get his 10.1% for part of his monies. Then he can forget about it to a degree. He's got stable, solid, secure banks with all the little logos. He's not too worried about that. But I think he says, in terms of defensive notes, he does a lot of note investing. And he says generally it's going to become more difficult for the structurers and the banks to agree to, to get to these digit numbers. And we've been used to conditional income and even fixed income at being at 12 and 13 and 14. But because of the time continuum we're in at the moment, there's a lot of stress and there's a lot of doubt in terms of anxiety. Is it coming? Is it going? And he said, look, I'd rather take something I can understand and watch very carefully and lock it in now because it's going to get more tricky. So, Graham, I know you've had a lot of arm wrestling, and thank you very much for beating the guys at BBVA and making their eyes bleed. As you mentioned to me. So a little bit over to you in terms of maybe your view on that.
No, absolutely. It's a very good point, Andrew. And I think, just for everybody's understanding, fundamentally, and the people who are heavily involved in structured notes could argue all day, dare I say all night as well, as to, what are the important features that go into the pricing of a note. But really, it boils down to 2 points: the interest rate and the price of the options. Now, fundamentally, the interest rate is quite straightforward. It drives the investment, it drives the note, and not only does it drive it, but it also is an integral part of the institution that we utilize. So, for example, if you took a German state bond, it would probably pay a little less than the Euribor rate because it's absolutely solid. It's effectively backed by the German government. But if you then go to and I always use this analogy, if you go to a Greek bank, they would have to pay considerably more, for your money because of the risk of effectively them defaulting. So interest rate is a very, very key part of a structured note. The other big factor, and sorry to go back to that, so interest rates, as we know, are at the level that they are. They were in ridiculously low, relatively speaking, not so long ago, and we've seen them upped principally due to COVID and some other factors as well. But and inflation being a key part as well. But we are where we are with the interest rates now, and so therefore that is a factorization that we must take into consideration. As I mentioned, the second point is the pricing of the options. Now, the pricing of the options is an element which fundamentally is to do with volatility. And volatility is that key word. Now, Andrew and I are constantly looking at the VIX, which is a volatility chart for what's happening in the investment world. And that's normally, you would normally use that when looking at indices, as in the large bourses around the world, the FTSE, the DAX, the Nikkei, etc., the JSE. That gives you an indication of what's happening in the investment world. Now, just to give you an example, VIX at the end of October 2008, as we know, credit crunch period, was at 60. 31st of March 2020, COVID is upon the planet. It was 53.5. VIX currently sits at 15. 1.5. So that tells you immediately that VIX is low. Now that's surprising, or people could be surprised by that, in the sense that we have war in Europe, we have activity around the world, whereby we've got the Suez Canal that effectively is blocked, logistics. We've got cargo ships in the oceans that are having to go around the Cape of Good Hope instead of going through the Suez. All sorts of factors in the world, inflation that we are getting under control, but is still bubbling. Various factors. You might think the VIX would be higher, but fundamentally, in comparison to what we see in the past historically, things are relatively dull. And this is referring to Andrew's point, in the sense that he did mention at one point where, boring is good. And we do have an element of that in the markets at the moment. Everybody would like to say, yep, we're going to have a problem. There's going to be a bear market. Is there a bear market? Is there a bull market? I would suggest it's just steadily ticking up. And for VIX, that means that level is very much down. Now, when you don't have volatility, it is incredibly easy to sell options because they're cheap. And when they're cheap, it means that you're not going to get a massive return. When you have high volatility, that means that effectively there are big returns available if to the investor who buys options, because there's a lot of money has to be paid to be able to sell them to the market. And so therefore, those are the big factors at the moment. Now, we have a situation where we stand at the moment whereby VIX is down. We've got an incredible basket there, which is not volatile. It's not massively volatile. So therefore, as in the 4 shares within the basket. So therefore, to be able to squeeze out more than 10%, okay, just 0.1% over 10%, but let's call it 10%. To squeeze out 10% per annum with, as Chad eloquently explained, the capital protection barrier of 50%, and an income trigger of 50%, then, and when you think the US rates are around about, if you put your money in the bank, or put it this way, if banks trading between each other, they have to pay roughly around about 5%, and we're getting 10% on a structured note with 4 huge European banks in the basket, then as Andrew says, we've worked hard. And I think together, collaboratively, between Cashbox and IDAD, we've got something that, again, as Andrew mentioned or alluded to, is a wonderful backbone investment to an individual's portfolio. So in answer to the question, it's difficult to get the returns that we're achieving at the moment in the notes, and I can't express enough how difficult it has been, but particularly when you want to deal with a bank with the stature of BBVA, again, an incredibly solid bank, great ratings. If you look at at the cost of placing money with that bank, and to ensure the premiums are incredibly low because it's such a solid bank. So when you put all of that together, to be able to deliver to you as an investor a 10% return per annum under the parameters of the note, then I'm happy. I'm very, very happy. And I know Andrew is, and I know the Cashbox team are. So if that answers the question, I hope it does, Andrew.
Thanks a lot, mate. Yeah, very good.
Fantastic.
Excellent. Any other questions? I see Piers asked us for a GBP note.
Good, Pierre.
We've got it on our to-do list. It's definitely there.
Yeah, I mean, just to add into that point, the differential between GBP and USD at the moment is minimal. Andrew remembers the time whereby it'd be a perfect justification to be able to FX between those two currencies, to be able to get a denomination in a note, because if you saw the opportunity, you would switch, because there was quite a bit of difference between USD and GBP. But it's pretty well tuned in now, simply because we're running parallel as two geographical areas, and currency levels as well. So yeah, it's I'm glad Cashbox are looking at it, because we can certainly price that.
Excellent. We do have a question. We've got Sage Business Consulting raised his hand.
Oh gosh. Okay, that's it's Chris.
Oh, hi, Chris.
Chris Wellham. How's it, Chad? How's it going? Yeah, I've just had a quick look at the stocks as they stand at the moment, and I see the first three being Santander, Deutsche Bank, and ING have since about September 2020 gone on a bit of a run, and I just wanted to know if you felt that that was sustainable, or if there was any likelihood of a severe drop in that 6-year period.
Okay, so I'll take that first, Chris. I mean, our view is, well, number one, if I was to tell you I knew what was going to happen, I would be lying. That's the first point. The second point is that because we are able, within the production of structured notes, to define contractual terms whereby we can defend against any major ups or downs, I'm very comfortable to say that no matter what happens with these shares, with these bank shares, I'm comfortable that parameters that we have in place within that shape, that we can still deliver a return for you as the investor. And you know, as Chad pointed out in the framework of the shape, you know, we've got great capital protection barriers. We've got an income trigger of 50%. So you know, as that states, it gives you the ability to have a flex of 50% from strike, which is the end of the month. And not only that, but we have that memory feature as well. So we effectively, you know, in accounting terms, we can accrue that income. When I say we, BBVA, through their balance sheet, can effectively accrue that income, such that you know, should we get to that point where we dip below the 50%, we know that if we recover, that we can accumulate all of the missed coupons and receive those as well. So in answer to your question, is there going to be a change in the share price? I'm absolutely convinced there will be. Which way it's going to go and by how much, that I can't tell you. And Andrew, if you can, then I'm all ears.
Well, I'll give you my uneducated guess. Yeah, Chris, it has been a sector that we've been wanting to get into, and correctly, from a quick squiz at charts and what have you, you can certainly ascertain that the banks have done very well. In light of what I said earlier, rising interest rates, they make a lot of margin on net interest income in terms of us having to, the man in the street having to service debt. The actual fall from Monday, I mean, affected all those banks. Everybody came down. It was mass panic. Everybody started selling everything. But if you look in the main, we were talking about maybe 8, 9, 5, 4%. It's not a lot, but it's a little bit of a discount. And if you see what they've come back to, and I mean, if I look at today's trading right now on the screens, you know, all those banks, all those four are up between 1, 2, 3, 4, 4.5%. So they're all coming back strongly to perhaps the levels that they were perhaps at. If you look at I look at it from a technical position, and I do a lot of analysis under the hood in terms of perhaps the metrics, in terms of, and I mentioned it earlier, on the tech shares. Are those tech valuations actually manageable in terms of what their earnings are? The price earnings ratio. Is the company worth what you have to pay? You know, 100 times multiple. Now, these are all below 10% price earnings ratio multiple. So these are very, you know, very stable, very boring again companies. So yes, whilst they've had a run in terms of perhaps their valuation, it hasn't been done on a stretched price earnings multiple. You know, if you look at an NVIDIA, if you look at these tech stocks, if you look at the Magnificent Seven, some of them have got ridiculous and very stretched, eye-watering valuations and price earnings valuations. So when you look at something that's got a PE, a price earnings ratio of less than 10, most asset managers are, that's the defensive side. And to Graham's point, to have a structure where the contract says, well, we will keep paying you this coupon as well as protecting the capital for a 50% reduction in the valuation of the company, kind of lends me to say, well, this is a very safe defensive sort of space to be in. Again, to my point, they are part and parcel of the intrinsic dynamic of the DNA of each country. Yes, they're Eurozone and global players, but they certainly have a very, very embedded footprint in their own country, whether it be Spain, whether it be Germany, et cetera, et cetera. I mean, Deutsche is the biggest bank. Commerzbank, we had a recent launch with a Commerzbank component as well. We look at the top, the top draw stuff. So this is not, to Graham's point, looking at, with respect to anybody on the call, to any Greek banks or Albanian banks or Lithuanian banks. We are staying, if we want to be true to our mantra, we need to stay with, the big banks who are stable, who are part of the DNA, who are not going to falter. We're not looking at a regional bank in the United States, for example, where there are potential problems. We had a very interesting discussion the other day. Regional banks look after, I'm not talking about the tier one banks. The regional banks look after maybe people who are perhaps lower income earners who maybe with these high rates are going to default first. So we've gone for the creme de la creme, if you want to call it that. That's not to say that these big banks are not infallible. We saw that with Credit Suisse. But we've looked at it very carefully on a number of other different metrics, whether it be credit default swaps, insurance, in terms of what it would cost to actually insure this debt. And as soon as it gets past a certain point, we say, no, we're not interested. So, a lot of work goes in behind the backgrounds. Happy to take it offline and chat. But, to Graham's point, there is a degree, look, if somebody presses a big red button in the Ukraine and, ballistic missiles start flying all over the world, then it doesn't really matter where your money is. I always say that. We kind of looking at a turkey shoot. You don't know what's going to happen. But I think we've at this point decided for this particular note to allow clients to say, well, I don't have a big risk appetite. There is all this stuff happening in the world. This does, make sense to me as an investor in terms of being defensive, getting a double coupon return with big companies. So, that was really the semantics behind the launch of this product.